And it's another exciting afternoon of markets, analysis, and insights on Business Incorporated here from Channels Television Lagos. Here's what's coming up on the program. South Africa's food supply comes under threat. And Kenya set for standard gauge railway loan payments with $451 million outlay. Nigerian banks' credit to government declines in May. Hello, it's good to have you join us on the program. I'm Will Ibang. Let's get right to business. And we're heading again straight to the markets, kicking off with equities in Africa. We're at intraday. Major equities were trading with negative sentiments. Nigeria's NGX was down 0.47% as expected after the huge profit the market made yesterday. Investors, traders are bound to start selling off and taking profit. Now, we see South Africa's EGX was down at intraday, opening the first trading day in the negative territory, down 0.13%. Now we scoot over to Egypt, where the EGX, South Africa was down. Now when we look at Egypt, as I was saying, was down 1.19%. Kenya closed yesterday's session in the green. Now we'll look at other Middle Eastern markets where bullish sentiments persisted, mixed at intraday. Abu Dhabi's index was up 0.21%. Dubai was up 1.41%. Now we look at the other side, Saudi and Qatari indexes are also up 0.37 and 0.72% each. Now Germany has long been the strongest economy in the EU, but the bloc's economic engine is sputtering, and this is because of skilled labor shortage that has many Germans worried at the moment. Lars Alter joins me from Berlin. Lars, how can the country get out of this tricky situation?
Good question, and thanks for having me. We need more people. That's the only solution. More people in general, but also more already skilled people. And if you ask the government's Council of Economic Advisors, there is just one way to get there, and that is immigration. Allow more foreigners into the country and into the workforce. And Monika Schnitzer, she is one of those highest-ranking economic advisors to the government in Berlin. She says that 1.5 million immigrants are needed per year to keep up with demands on the labor market. Now, something like this is, of course, easier said than done, but there are a few good points on how to turn this plan into reality. First of all, Germany is already a popular country for immigrants with its political stability, relatively high wages, health insurance. Generally, there are a few good reasons to come here, but according to the economic advisors, Germany has to establish a more welcoming culture down to the immigration and job centers, where to date foreigners need to talk German to get pretty much any job at all. Nonsense, say some experts. We need skilled people in the country, so make those working in the job centers speak English or maybe some other language that helps with recruiting. Of course, there's a few other ways too when it comes to strengthening the workforce. Retaining older workers is one of them, but much more important, better train children and the youth. School statistics as of late haven't been very inspiring, with as many as 25% of grade schoolers not at sufficient reading level. So it seems we need to fix schools and universities and raise the highly qualified experts that the economy will eventually need.
So what parts of the economy are most in need of skilled workers?
Well, the problem is felt pretty much everywhere. 42% of German companies said over the past 6 months that they have felt a shortage of skilled labor and that it had slowed down their business. In the service sector, it was actually 47%, so almost half of all companies in Germany have that problem. There are regional differences, with the eastern part of Germany having bigger problems than the western part. Some of it is likely due to a still existing wage gap, retirement cap, and also a lack of large companies in the east, where at this point only a few of the country's largest corporations are even headquartered. Looking at some sectors of the economy in particular, there's a huge shortage of skilled workers in manufacturing and industrial production, whether that's cars or machines, metal works, but also food and agricultural goods. It's currently hard to get construction projects done or to install water and heat. The public transportation sector is in trouble, the telecom sector, but also when it comes to services, hotels, restaurants, hospitals, and retirement homes. So this is indeed a very broad topic. Germany needs skilled labor just about anywhere.
And so how do markets and businesses see this work out in the long run?
Well, businesses can hardly wait for this situation to improve. However, we're talking about a big problem and very long-term solutions. Obviously, any investment in children, for example, schools, university, won't really pay off until years from now. And bringing in foreign workers is already happening. But those people need not only a welcoming culture, but also simply housing and infrastructure. So the mood is anything but optimistic right now. Experts have warned for a while that Germany is no longer leading in many fields, specifically with an eye on innovation and digitalization. Germany might have been among those countries leading the world, but it is no longer. And that, of course, means that other countries might offer even bigger opportunities for those looking for work from abroad. And when it comes to people from there, for example, that could make the situation for Germany even worse before it gets better.
Tough situation there, Lars. Thank you so much for the update. Now let's head to the UK, where mortgage rates have been rising consistently since May. Juliana joins me from London with the details. Juliana, good afternoon. Now, see, average mortgage rates has risen above 6% for 5-year fixed deals. Are lenders pricing in expected Bank of England interest rate hike here?
Good afternoon, Will. Well, that's exactly what lenders are attempting to do, but it's a bit of a minefield for them because we have no idea what is going to be the next step from the central bank. Of course, for 13 consecutive times, they have raised their base interest rate. It's now at 5%, and they're doing this because, of course, they want to bring down inflation in this country, which is currently at about 8.7%. But as they are doing this, the cost of borrowing is too high for mortgage holders in this current country who are already on the brink. As you quite rightly said, just a couple of hours ago, for the first time since Liz Truss's disastrous mini budget in November, a 5-year mortgage deal interest rate has gone above 6%. Of course, this is going to affect millions of homeowners who are already struggling, but not just homeowners. It's also going to impact renters too, because of course, their landlord is going to be experiencing higher bills. This is causing lots of concern across all party benches. Just a couple of hours ago, we did hear from the Liberal Democrats in this country. They're asking for a £3 billion mortgage protection fund so that anybody who is struggling will not be at risk of losing their home. And I think the Conservative government are trying their best to avoid that. We did hear from the Chancellor of the Exchequer, Jeremy Hunt, last week following a meeting he had with some of the big banks, and he said he has made sure that there is an agreement in place that anybody at the moment who is struggling can come to some sort of arrangement with their bank to ensure that over the next 6 months they'll only be making interest payments, or they'll be able to extend their mortgage term, which would mean that their monthly payment does go down. But it is a huge concern. I think within the next couple of minutes, the Prime Minister is likely going to be grilled on this subject because he will be having a grilling session, shall we say, with the liaison committee, which is a cross group of party MPs who will be discussing the business of the day with the government, which is the cost of living crisis that is not going anywhere.
You definitely keep us in the loop on what they decide in that meeting. Now, we also see the Financial Conduct Authority summoning UK bank bosses to discuss weak savings rates. It appears this issue of profiteering is not just focused only on the retailers in the UK, as we've seen since last week.
Absolutely, Will. This is a conversation that has been ongoing for the past couple of weeks. But I think when it comes to banks and interest rates, people are saying it's blatant profiteering. There is no innuendo about it, which is why the Financial Conduct Authority have hauled in the bosses of HSBC, NatWest, Lloyds, and Barclays to find out why the successive interest rate hikes, which has seen the base rate hit 5%, is not being passed down to savers. Now, believe it or not, even though we are engulfed in a cost of living crisis, in the United Kingdom, there are more savers than there are those who have major loans. So at a time when we are going through a significant economic crisis in this country, the government and the regulators want to ensure that the banks are passing down those profits to savers, which they aren't doing. So currently, if you do have any savings, what you'll be seeing is some sort of rate of about 2.45%. Now, of course, that's less than half of the 5% base rate that we have seen from the central bank. And we're certainly going to be seeing interest rates rise even higher in the coming months as the government and the Bank of England try to tackle soaring inflation. So yes, that is the premise of the discussion between those big banks and the Financial Conduct Authority. There is no legal requirement for them to pass these profit margins down, but considering that they have enjoyed successive rate hikes over the past year, I think that Jeremy Hunt, the Chancellor, is putting pressure on them to make sure, considering we are going through a significant cost of living crisis, that those that can benefit from some of the rate hikes do get exactly what they deserve.
So how are markets reacting to all of this?
Markets are looking pretty good at intraday, Will. We've had some trading updates from some airlines, Wizz Air and Ryanair, some of the budget airlines operating out of Europe. They've had a great couple of months heading into what is likely to be a busy summer period. That's pushed up the all-share index at intraday, which is up by 0.15%. The FTSE 100 is up by 0.19%, and the FTSE 250, the domestic market at intraday, is up by 0.29%. There's also been a rally in the currencies market. The British pound is currently trading up 0.12% against the US dollar, also trading up against the euro by 0.23% and up against the Japanese yen by 0.02%.
Thanks, Juliana. Always bringing us the facts behind the figures. Now we move on to other markets in Asia, where stocks were mixed as investors further assess the Reserve Bank of Australia's decision to hold its rate steady at 4.1%. Australia's S&P ASX 200 paired earlier losses and rose 0.45% to end its session. In Japan, the Nikkei 225 retreated from a new 33-year high recorded on Monday, falling 0.98%. 33,422 points. South Korea's Kospi fell 0.35% to close at 2,593 points. And this comes as the country's consumer price index grew at a slower rate of 2.7% in June, marking a fifth straight month of decline. Now, in mainland China, the Shanghai Composite rose marginally to close at 3,245 points. Hong Kong's Hang Seng Index also rose 0.61% in its final hour of trade, led by energy and industrial stocks. The Hang Seng Tech Index rose 0.7%. Now, U.S. markets are closed today for the nation's Independence Day holiday. But let's see what's happening in the oil space, where prices held steady on Tuesday as markets weighed supply woes from cuts for August by top exporters, Saudi Arabia and Russia, against economic data that hinted at weak crude demand. Brent crude futures were up 0.3% at $74.87 a barrel. West Texas Intermediate crude were at $70.06 a barrel. The oil benchmarks had settled down about 1% in the previous session. Saudi Arabia on Monday had said it would extend its voluntary cut of 1 million barrels per day from output to August. Russia says it will also reduce its oil exports by 500,000 barrels per day in August. The cut amounts to 1.5% of global supply and brings the total pledged by OPEC Plus oil producers to 5.16 million barrels per day as both countries look to prop up prices. Now, gold futures were flat on Tuesday in thin trading due to a U.S. holiday, while traders awaited the U.S. Federal Reserve's minutes of the June meeting on Wednesday for more clues on its interest rate hike path ahead. Spot gold was little changed at $1,921.39 per ounce, while U.S. gold futures were flat at $1,929.10. Trading volume could be light due to your U.S. holiday, as I mentioned earlier. Investors are seeing a nearly 10% chance of a 25 basis point hike in July, according to CME's FedWatch. That's bringing rates into the 5.25% to 5.5% range. Markets will also watch for minutes of the June 13 to 14 minutes being released Wednesday. The Reserve Bank of Australia's policy decision would also be watched during the Asian market hours. After the break, more updates from the commodities market space. This is Business Incorporated. Do stay tuned. Welcome back. Now we're going to be looking at another commodity, which is lumber. We've seen global lumber prices have risen by 13.67% to $524 per 1,000 feet in June, from $461 per 1,000 feet in May. What are the reasons behind the current market sentiment, and where do we see this trend going? Adeye Adegbusi, analyst, financial derivatives company, joins me to provide insights. Good afternoon, Adeye. It's good to have you on the show. Adeye, could you tell us why we're seeing this trend, this upward trend in the price of lumber?
So lumber prices have been volatile since the start of the pandemic in 2020. The prices dropping and rising drastically over the past 2-3 years. So to give a brief background, so in early 2022, prices rose to about 1,400 per 1,000 feet, owing to rising demand for housing in the US, as well as supply shortages from Canada amid unfavorable weather. But however, it's good to know that it was still below its peak in May 2021 of $1,600 per 1,000 feet, which was driven by pandemic-fueled housing boom. But the price was still 3 times higher than the pre-pandemic average price. Then later on in 2022, we saw lumber prices starting to decline, owing to squeezing disposable income and higher mortgage rates in the US. But now, as you said, lumber prices have been on the up. We're rising to about $524 in June, which is attributed to the same supply shortages, as well as a boost in demand as summer construction season is approaching. In Canada, wildfires have been estimated to destroy about 4 million hectares of timber, which has forced sawmills in the country to suspend operations, and has led to supply disruptions. Especially the fact that Canada is the fourth largest producer of lumber in the world. And also, new housing starts in the US rose by 22% in May, indicating a rebound in the housing sector, and has led to improved demand for the commodity. So with this, we expect lumber demand and lumber prices to remain elevated in the near term.
Adeye, we've seen since the start of this year, mortgage rates in the US and the UK have been rising. We just spoke about UK's rates reaching a 6%. US now, we've seen for the 30-year fixed rates has fallen as low as 6%. It's been volatile in the UK, but in the US. But how will this affect the long-term demand and the outlook for commodities, for lumber in particular?
So since 2022, mortgage rates in the US have nearly doubled, rising to about 7%. And of course, it's good to know that there are 2 types of mortgages. There's a fixed mortgage and there's a variable mortgage. So in terms of the variable mortgage, the price you pay depends on the level of interest rates in the economy. So if interest rates increases tomorrow, your mortgage payments will rise, and vice versa. So in terms of fixed mortgage rates, you pay a fixed amount over a certain number of time. So institutions that offer this package often set their rates depending on the outlook of the central bank's monetary policy. So If there's an expectation of a rise in interest rates, the mortgage rate will be higher. So now, giving an example, like now that the US Fed decided to pause, its monetary tightening cycle last month, it has still indicated that it is willing to, of course, raise interest rates further about at least 2 more times this year to bring down inflation to its target of 3%. And now that the expectations of higher interest rates in the near term, you can see mortgage rates increasing. And it's important to note as well that just a percentage point increase in mortgage rates can mean that an individual will pay hundreds of more dollars on his monthly payments. And this combined with the squeeze in disposable income will lower demand for houses and consequently for construction communities like timber in the longer run.
And so let's bring it home to Nigeria here. We see, according to the Global Forest Watch, Nigeria has lost about 1.25 million hectares of tree cover, and that's equivalent to about 12% decrease in let's say, tree cover since 2000, and equal to 671 million tons of carbon dioxide emissions from 2001 to 2022. What steps can be done? What steps do you think the government can take to lower illegal deforestation and also illegal logging in the country?
So deforestation has been a major problem in Nigeria over the years, and it has significant impact on not just the environment but the people. Deforestation leads to soil erosion. It reduces biodiversity and also creates it also accounts for a large number of carbon dioxide exerted into the atmosphere. So, and this can be attributed to a number of things. You can see illegal logging, which is directly linked to corruption and weak infrastructure. So there are a number of ways to improve to reduce deforestation and illegal logging in the country. Firstly, you can see the use of sustainable agricultural practices such as agroforestry, afforestation, reforestation, and also the implementation of strong laws and enforcement of stringent laws on deforestation and illegal logging. And you see Nigeria tapping from, and with this, Nigeria will tap from the vast markets for timber, for wood, for lumber in the country and also outside the country as well. And you can see the government has not a Red Plus strategy with the UN, which is aimed at reducing deforestation and illegal logging in the country, and hopefully we'll see an improvement in the sector.
Thanks so much, Adeye Adegbusi, analyst, financial derivatives company, sharing those insights, and we look forward to lower deforestation in Nigeria. Thank you.
Thank you. Thank you for having me.
Now, moving on to other stories in South Africa, we've seen a recent report by PricewaterhouseCoopers, PwC, that's saying that South Africa faces an alarming risk of increased food insecurity as multiple factors converge to disrupt the country's food supply. This is from the financial advisory firm South Africa's Economic Outlook, released in June, and shedding light on the challenges faced by businesses in the current economic climate. Load shedding, it says, adverse weather conditions and deteriorating infrastructure have been identified as key culprits behind the disruption. The Global Food Security Index ranks South Africa 52 out of 113 countries in terms of food availability. However, PwC expresses concerns that this ranking may worsen by the end of 2023. We move over to Kenya, where the country's treasury is bracing itself for a fresh raid on its foreign exchange reserves to fulfill external debt service worth $451.3 million this month, with the bulk of the funds covering the biannual repayments for the standard gauge railway loans procured from China. A World Bank analysis of Kenya's external debt obligations shows significant payments to a mix of bilateral, commercial, and multilateral lenders in July, including France and China. Data shows that January and July account for the biggest debt service outflows in the year due to the SGR repayments. Meanwhile, the real impact of these large repayments on Kenya's finances is amplified by the continued weakening of the shilling against the dollar. Now, data released by the Central Bank of Nigeria on money and credit statistics shows that credits from banks to the government fell in May 2023. A breakdown of the data shows that on a month-on-month basis, bank credits to the government fell by 70 billion naira to 30.69 trillion naira in May 2023 from 30.76 trillion naira in April this year. However, credit to the private sector increased month-on-month by 5% to 44.2 trillion in May 2023 from 43.6 trillion in April this year. As a result, net domestic credit increased to 74.9 trillion during the period from 74.2 trillion recorded in April, which implies an increase in funds available for investment in the economy. Experts, however, believe that the fall in government credit will mitigate the risk of the government's borrowing crowding out private firms' access to funds from productive investments in domestic financial markets. And that's it on Business Incorporated. Thanks for watching. I'm Will Ibang. See you tomorrow.